Benjamin Graham is often introduced as the father of value investing, the man whose research, ideas, and philosophy laid the intellectual foundation of modern stock market investing. But to truly understand why his approach continues to influence the world's greatest investors, from Buffett to Howard Marks, we must go back to where everything began, a childhood shaped by financial hardship and a world defined by uncertainty. Born in 1894 to a Jewish immigrant family in London and later raised in New York City, Graham's early life was divided into two contrasting halves. First, a period of comfortable prosperity thanks to his father's successful business importing fine porcelain, then, a period of crushing financial stress after his father's sudden death. With financial support gone, the family was thrust into an unforgiving reality, his mother selling off household possessions just to survive. Young Benjamin experienced firsthand what it meant to lose everything. That experience would later inspire his life's work, finding a rational method to protect capital against the chaos of economic uncertainty. His academic brilliance earned him a scholarship to Columbia University, where he graduated second in his entire class at just 20 years old. Offered teaching positions in mathematics, philosophy, and English, he declined, all because he had a bigger ambition, to pursue a career on Wall Street. The timing could not have been more dramatic. Graham entered the financial world during the Roaring Twenties, a period of explosive economic expansion, booming stock prices, and rising speculation. At first, he participated in the excitement, trading actively and generating significant profits. But beneath the market's glittering surface, he saw danger, valuations disconnected from real business fundamentals, rampant speculation based on rumors rather than financial logic, and an entire investing culture driven more by greed than rational thought. Then came 1929. The Great Depression obliterated fortunes overnight, turning optimism into panic. It was the single largest financial collapse in history at the time. Many investors quit the market forever, but Graham did the opposite. He questioned everything he thought he knew. Why did stocks rise far above real value? Why did investors ignore risk until it was too late? How could a rational investor avoid losing everything in a crash? These questions pushed him to transform investing into something systematic, something grounded in truth, not emotion. He began analyzing companies not as numbers on a ticker tape but as real businesses with assets, earnings, and intrinsic value. His belief was simple yet revolutionary: the stock market is there to serve you, not to instruct you. Graham realized that every business had a real, measurable value independent of market behavior. The stock price may swing wildly from day to day, but the underlying business remained the same. If an investor could calculate that true value, called intrinsic value, then they could buy companies when they were priced far below what they were worth, and patiently wait for the market to recognize their real value. Value investing was born. Graham would spend decades refining a strategy that combined deep financial analysis with emotional discipline. He realized most investors didn't fail because of lack of information, they failed because of fear, greed, and impatience. So he developed a philosophy designed to protect investors from their own worst instincts. One of his most important teachings came from the character he invented in his legendary book, The Intelligent Investor, Mr. Market. Mr. Market is not rational, he is emotional, wild, and unpredictable. Some days he is euphoric and willing to pay crazy prices for stocks. Other days he is depressed and offers to sell you companies for far less than they're worth. Graham's wisdom was, you are not required to trade with Mr. Market. You choose when to act. If his prices are irrationally high, stay away. If his prices are irrationally low, buy with confidence. This concept fundamentally transformed investing into a discipline of patience and rationality. But Graham knew valuation alone wasn't enough. Even when buying undervalued assets, things could still go wrong. Therefore, he introduced the single most important rule in value investing: the margin of safety. Just as an engineer builds a bridge strong enough to hold far more weight than necessary, an investor must demand a significant discount to intrinsic value before investing. It was a principle born from his early financial trauma: never assume the world is safe. Expect the unexpected. Build protection into every decision. The New York financial community initially dismissed Graham's ideas, too cautious, too slow, too different. But history proved him right. His investment strategies consistently delivered strong returns while avoiding catastrophic losses. More importantly, his philosophy changed how generations would think about investing. And among his students at Columbia University was a young man from Omaha who worshipped Graham's teachings like scripture, Warren Buffett. Buffett would later say, "Ben Graham is the man who changed my life. It is thanks to him that I learned the true path to investing." As Graham continued to teach and refine his ideas, he became not only an investor, but a mentor, a philosopher, and a pioneer. Value investing became more than a strategy. It became a mindset. A way to force rationality into an irrational world. A shield protecting investors from disaster. And at the heart of that shield was margin of safety, a principle that would define Graham's legacy forever. In the next chapter, we dive deeper into how Graham calculated intrinsic value, protected investors against fear, and built the foundations of the most successful investment strategies of all time. Benjamin Graham's rise as a financial thinker was not born from instant success, it emerged from relentless experimentation, brutal market lessons, and years of refining methods through real-world investing. His famous plays in the early 1930s were not high-risk bets but carefully calculated opportunities, based on a principle, buy a dollar for 50 cents. The idea sounds simple today, but in Graham's time, it was revolutionary. Investors were chasing trends, rumors, and excitement. Graham was chasing truth. He focused on what he called intrinsic value, a company's true economic worth, measured by assets, earnings power, dividends, and long-term business fundamentals. But the market wasn't efficient or rational. Sometimes strong companies were priced like they were dying, and that was where Graham made his fortune. One of his most famous early successes was the Northern Pipeline Company. While Wall Street ignored it, Graham discovered the company owned valuable assets, including liquid investments worth far more than its stock price reflected. Graham wasn't just looking at the company's earnings, he looked at what shareholders actually owned. When the numbers clicked, he acted decisively. The margin of safety was enormous, the downside tiny, and the upside massive. He purchased shares aggressively, then forced corporate changes to unlock value. The stock soared. His students would later mimic this strategy, Buffett most famously. Buffett called Graham ever after, "my spiritual father in finance." But Graham's genius wasn't only finding bargains, it was protecting capital from human error. He saw the market as a psychological battlefield. Fear and greed weren't occasional forces, they were constants. During euphoric booms, people abandon discipline. During crashes, they abandon reason. Graham once said, "Individuals who cannot master their emotions are ill-suited to profit from market opportunities." His teachings were a warning as much as guidance. No matter how smart you are, if you cannot detach emotion from money, the market will eventually destroy you. To combat that, he developed strict rules, not suggestions, to keep investors rational. He split the world into two types of investors. Keycap 1, the defensive, passive, investor, cautious, avoids frequent trading, focuses on high-quality undervalued companies and bonds. Keycap 2, the enterprising, active, investor, performs deep research, finds neglected opportunities the market mispriced. But both had non-negotiable requirements, discipline and patience. Perhaps Graham's most enduring emotional framework was Mr. Market, his fictional character who shows up daily offering to buy or sell shares at wildly varying prices. Some days euphoric, offering absurd sums. Other days depressed, practically giving assets away. Graham warned, ignore Mr. Market's moods. Focus on reality. A business remains the same whether Mr. Market is manic or miserable. Investors should take advantage of him, not follow him. Graham didn't just speak theory, he lived it. His investment firm, the Graham-Newman Corporation, built a track record that would become legendary. From 1936 to 1956, they delivered returns of nearly 20% annually, not by chasing the newest craze, but by buying undervalued businesses carefully and waiting. What others saw as boring, Graham saw as safe, logical, and consistent, qualities rarely appreciated until hindsight. Yet Graham remained deeply humble. He openly admitted, "We will all be wrong sometimes. Even the most careful investor cannot predict the future perfectly." That's why margin of safety was non-negotiable. It wasn't about trying to be right, it was about avoiding being wrong in a way that destroys you. A single mistake can wipe out years of success. Graham wanted mistakes to be survivable, not fatal. This philosophy reached its full form in his masterpiece, The Intelligent Investor. Published in 1949, the book was a guide not just for investing, but for thinking. It taught readers to treat every stock as ownership in a real business, not a lottery ticket. It taught that risk doesn't come from volatility, it comes from not knowing what you're doing. And it taught that investment success doesn't belong to the fastest or flashiest, it belongs to the most disciplined. One of Graham's most brilliant insights was that human behavior is cyclical. Investors always believe, "This time is different," until history proves otherwise. Speculation is disguised as innovation. Overconfidence becomes blindness. Then the illusion collapses, and money returns to rational hands. Graham benefited from those cycles, because he refused to participate in the madness. He stayed grounded in arithmetic, in hard facts, in patience. And when a crash came, value investors like Graham weren't ruined, they thrived. Crashes were simply big sales. But Graham wasn't only an investor. He was a teacher, and perhaps his greatest investment wasn't in a stock, but in a student, Warren Buffett. Buffett entered Graham's class at Columbia already obsessed with his ideas. He sat front row, consumed every word, and asked endless questions. Graham immediately noticed something rare, a student whose personality was perfectly built for value investing, calm, rational, patient, with zero attraction to speculation. Buffett would later say, "Studying with Ben was like learning basketball from Michael Jordan." Graham saw that Buffett didn't just understand the formula, he understood the spirit of value investing. So he hired him at the Graham Newman firm, the only job Buffett ever begged for. It became a passing of the torch. Graham's influence would reshape Buffett into the most successful investor in history. However, Buffett did not copy Graham without modification. Graham believed deeply in buying cheap assets, even if the business quality wasn't strong. Buffett, later influenced by Charlie Munger, evolved the philosophy further. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But Buffett always credited Graham as the root of everything. Without Graham, there would be no Buffett as we know him. If Graham gave the world the compass, Buffett built the map. But every value investor, from Joel Greenblatt to Seth Klarman to Monish Pabrai, still uses the tools that Graham forged. And those tools remain valuable because they are based on human nature, which does not change. People still panic during declines. People still chase hype during bubbles. And investors still need protection from themselves. Toward the end of his career, Graham shifted his focus from stock picking to grander questions. How can ordinary people protect and grow wealth in an unpredictable world? How can investment be democratized, safe not only for professionals but for everyone? These questions would lead him to refine the last and greatest version of his philosophy, a systematic defense against uncertainty, a philosophy we will explore in Part 3 as we uncover the full power of margin of safety and the enduring legacy of Benjamin Graham. Benjamin Graham's greatest gift to the world of investing can be captured in 3 words: margin of safety. It is a concept so simple that anyone can understand it, but so powerful that it has guided the most successful investors of the last century. Margin of safety means protecting yourself from the unknown. It is a philosophy built on realism. We do not see the future clearly. We do not predict perfectly. We make mistakes. The economy changes. Businesses stumble. Human psychology collapses under pressure. And yet, investors still must act. Graham's answer was not to avoid risk entirely, but to prepare for its inevitable impact. He compared it to engineering. A bridge built to hold 10 tons should never carry 10 tons. It should be built to hold 30. Why? Because life happens. Stress, surprise, erosion, unforeseen forces attack structure. The same is true in financial markets. A stock may look stable, a business may appear unstoppable, but assumptions are fragile. The margin of safety is the buffer between expectations and reality, the gap that keeps an investor alive when the world does not cooperate. To Graham, stock prices were not opinions, they were opportunities or traps. Buying a strong company at a fair price wasn't enough. He demanded a discount so significant that even if his analysis was flawed, the risk of permanent loss remained minimal. This was not pessimism, it was humility. Graham warned that overconfidence is the deadliest enemy of wealth. If you assume you are smarter than the market, you have already lost. If you assume the market can trick you, you may survive long enough to win. His brilliance was that he turned investing into a discipline, not a gamble. Rules over excitement. Logic over emotion. Process over prediction. Graham often reminded investors that the stock market is a voting machine in the short term but a weighing machine in the long term. Short-term prices reflect popularity, who's voting yes or no today. Long-term values reflect weight, what the business is truly worth. Most investors obsess over the voting machine. Graham focused exclusively on the weighing machine. In downturns, when others saw fear, Graham saw mispricing, and therefore fortune. Crashes did not frighten him, they energized him. Panic creates bargains. Margin of safety thrives in uncertainty. That is why value investing is most profitable when others are suffering. Graham encouraged investors to welcome volatility, not avoid it. Price declines become your friend when you are prepared. This philosophy changed the mindset of generations. White heavy checkmark do not celebrate rising prices, they reduce opportunity. White heavy checkmark do not fear falling prices, they create opportunity. White heavy checkmark do not predict, calculate. White heavy checkmark do not follow, think. Graham separated two characters living inside every person. The investor and the speculator. The investor is patient, realistic, guided by discipline. The speculator is impulsive, emotional, guided by excitement. He believed that success in markets was not primarily intellectual, but psychological. It is easier to solve an equation than to control fear. It is easier to build a spreadsheet than to resist envy. Graham's methods were created to protect investors from themselves. Even after retiring from professional investing, Graham continued writing, teaching, and refining his ideas into principles simple enough for anyone to use. Those principles became immortal through The Intelligent Investor, a book Warren Buffett calls, by far the best book on investing ever written. It remains foundational because it does not teach how to get rich quickly, it teaches how to never be wiped out. It teaches survival first, success second. Through his writings, Graham democratized financial wisdom. Before him, successful investing was seen as exclusive, only for insiders, professionals, or the wealthy. Graham proved that ordinary people could compound wealth safely if disciplined. He gave them a roadmap to navigate chaos. And most importantly, he gave them control over their financial future. His personal life also reflected his philosophy, modesty, generosity, and intellectual curiosity. Unlike many financial titans, Graham did not seek fame or worship. He lived simply. He loved classical literature, poetry, and philosophy. He believed that money was merely a tool, not a measure of life. He once said, "Money is the servant, not the master." That belief kept him grounded while others chased extravagance and ego. His investment performance left a legacy, but his students made him eternal. Buffett himself became a living monument to Graham's teachings, yet always emphasized, Ben is the father of value investing. The world's greatest investor insists his success is simply Graham's ideas, optimized and patiently applied. Today, value investing remains as relevant as ever, because human nature remains unchanged. Markets still swing wildly with emotion. Investors still chase trends, panic during downturns, and ignore fundamentals until it is too late. Margin of safety remains the shield against these timeless behaviors. But perhaps Graham's most profound lesson is this. You do not need to be brilliant to succeed, just patient, rational, and disciplined. The market rewards those who think independently. Those who wait for the right pitch. Those who measure value, not hype. Those who buy when the math, not the excitement, makes sense. Graham passed away in 1976, but his philosophy continues compounding in the portfolios of every disciplined investor. He built the foundation of modern investing. He gave the world a method to transform modest capital into lasting wealth. And he reshaped finance into a science, not a casino. In the end, Benjamin Graham didn't just teach how to make money. He taught how to preserve money. How to respect uncertainty. How to invest with wisdom. How to think independently and survive volatility. How to protect dreams from fragile assumptions. How to protect dreams from fragile assumptions. How to build wealth that lasts generations. His legacy lives in every investor who buys a business, not a ticker symbol. In every portfolio built with caution, not excitement. In every person who seeks value, not entertainment. Benjamin Graham is more than a legendary investor. He is the architect of rational wealth building. The protector of the cautious. The mentor of the greatest. The author of survival. And most importantly, the man who proved patience and discipline are the true engines of financial freedom. Thank you for joining us on this journey through the mind and legacy of Benjamin Graham, the father of value investing. His wisdom continues to guide those who seek not quick riches, but durable wealth built on discipline, patience, and rational thinking. If you believe in making smarter financial decisions and securing long-term financial freedom, you're in the right place. Stay curious, stay informed, and most importantly, invest intelligently. Make sure to subscribe for more deep-dive documentaries on the world's greatest investors and the timeless principles behind their success. More powerful stories are on the way, and you won't want to miss them.